Welcome to Wealth Matters Podcast. How are you doing today, Kim?
Just fine, Alpesh. I'm so glad we're getting to talk.
Absolutely. It's my pleasure. I have someone who I have been following for years, trying to learn the whole life insurance, especially life insurance industry overall. And I'm excited that you are here. And of course, we are going to dissect about whole life insurance. But in the meantime, can you tell my listeners what's your primary job or business?
Absolutely. So I am a financial advisor, and I coined a term a long, long time ago to help people understand that the financial work I do is a little bit different than the typical financial advice that you get out in the marketplace. And it is called prosperity economics.
Interesting. What do you mean by prosperity economics?
Well, when we learn the term economics, most of us learn that in high school. And
Yes.
I would have to say that most Americans probably hate their economics classes.
Right. Yeah. I never took an economics class, and I'm glad that I didn't miss anything.
Oh my gosh. I can tell you that I hated mine, and I don't even like using that word. I try to tell my children, don't use the hate word. That's a bad word.
Right. Exactly.
But the fact is that we all live in an economy, and we live in an economy in the United States. We live in an economy in our little city.
Correct.
And we also live in our own personal economy.
Right.
And so really, when you talk about personal finances, you have to think about them as an economy. So
Right.
hence the word economics. And then I just love the word prosperity because I think it is a lot more indicative of what we're really building. It's not just finance. It's not just wealth.
Right.
It's prosperity. And prosperity implies that wealth impacts our lives way more than just in the form of money.
Right.
And, there's so many things in our life that really matter, and money affects absolutely every single one of them.
Okay.
And so I just coined the term together and tried to make it be something that was helpful to people to understand that there is a different way to handle your personal finances than what most people talk about and call financial planning.
Yeah. No, interesting. So, can we talk about the life insurance policies? What are the different types of life insurance policies?
So right off the bat, I really want to alert your listeners that life insurance is often a very boring subject. We think about it. We think that it's all about death.
Yep.
And that's not accurate. It's called life insurance for a reason. And it's because it's about life. And so, as most people know, there's term insurance, and everybody that has a business, that has something that they care about, or somebody that they care about, should have some life insurance. And term life insurance is a great place to start. And if you do nothing else, just pop on the web and grab yourself some term life insurance. Super easy. Check it off the list. Done.
Yep.
Now, if you want to up level that one, then you want to look at something that's called whole life insurance. And again, I'll prepare your listeners that if you go ask 10 financial planner, financial advisor types about whole life insurance, 9.5 of them are going to say, oh, no, don't do that.
Don't do that. Exactly.
Yeah. So the question that I always like to ask is, why do we say, oh, nope, don't do that about a product that's been around for over 200 years?
Yes.
For something to be in existence that long, it has to have some validity.
Right.
And so I would just really encourage people to go into an open-minded learning mode. And the bottom line of whole life insurance is it's an awesome place to store cash.
Yes.
So it's a liquid dollar figure that's called cash value that you want to use as your emergency/opportunity fund.
That's a great analogy right there. So why do you recommend whole life insurance policy?
Because it's the best place to store cash I know. It's better than a savings account. It's better than a money market account. It's more efficient than a CD, a muni bond, a tax-free bond. All of those things that I just mentioned are earning 1 or 2% these days.
Right.
Most of them are taxable, minus the tax-free bond, obviously. And life insurance is going to earn probably closer to 3%.
Okay.
And that's in today's world. You know, we're recording this in 2020.
Correct.
And life insurance is also going to not be taxed. And so those two things right there make it more efficient place to store cash. And it's not for everybody. You know, if you're in your 70s or 80s, it's probably not going to work.
No, yeah.
But I have young adult children. They're just out of college, and they're using life insurance as a place to store cash. They're not married. Okay. They do not have children. And yet, because of its efficiency and because it stores cash better than any other place, they're using it. And, you know, so many kids out of school these days, they're forced right into their 401k plan.
Right.
That is not a liquid asset.
Yeah, and I don't like 401k.
No, the government controls that
exactly.
asset 100%.
Exactly.
And so you want to build an asset that you control. And it's not going to be for every dollar that you have. Of course, if you have a match, you might want to contribute to your 401k a little bit. But you want to have liquidity. Your emergency fund and your opportunity fund, that's what gives you peace of mind to sleep at night. It gives you the ability to change jobs if you want to, or you need to, or move across country, or travel, or do a myriad of other things that no other asset is going to do a good job of helping you do.
I agree. So you mentioned about that life insurance is not taxed, and I hear about it a lot as well. And for my listeners, can you explain what do you mean by that?
Yes, that's a great question. So let's again compare it to a 401k. Not that it's the best comparison, but it helps people understand. It's a good,
yeah, exactly.
Yeah. This is a good time for the video. You always have 3 phases of taxation. There's money going in, and then there's money growing, and there's money coming out. And with a 401k, you're going to get a tax benefit on the first two. With life insurance, you're going to get a benefit on the last 2.
Ah, okay.
So people often use the terminology, back to our 3 things, about you're either taxed on the seed, the money going in, or you're taxed on the harvest, the money coming out. And life insurance is a tax on the seed type of asset. A 401k is a tax on the harvest type of asset. And of course, ideally, your harvest is going to be bigger than your seed.
Yes, that's what you want.
Yeah. So you want to pay tax on the seed.
So if I compare whole life insurance to a Roth IRA, I think that could be a good comparison. They are pretty similar, if I may.
They are very similar. There's a couple of distinctions. Number one, as you know, Roth money is locked up till you're 59 and a half. Exactly. You can take your principal out. So that helps. Absolutely. But Roth contributions are also limited.
Yes.
And so one of my favorite CPAs is Diane Kennedy. She's done a lot of work with Robert Kiyosaki, who's fairly well known.
Okay, then I'm going to reach out to Diane Kennedy for a podcast.
Absolutely. And she says that life insurance is like a Roth for the rich. Because it has unlimited abilities for contributions.
You can put as much money as you want, as long as you don't reach to your MAC limit, right?
Right. Yep. So you'll want to reach out to Diane Kennedy, and there's another CPA, Tom Wilwright, that does a lot of work.
I love Tom Wilwright. So I met him. I love his book. I've always talked about tax-free wealth.
Fabulous.
Yep. So I met Robert Kiyosaki and Tom Wilwright last year, actually. So
great. Yep. Good matches.
Yeah, they're awesome. So this is great. So I have another question. I've been told when I was getting my life insurance, as well as when I reached out to some other agents too, that I can get 80% of the paid amount or the premium or the cash value as loan in the first 5 years. And then you should be able to borrow most of it. Is this true?
Yes, actually, most insurance companies will lend about 95%
Okay.
of the cash value.
Okay. So so let's say if I'm putting about 20 grand a year, there will be some percentage which would go to the premium and expenses, right?
Correct.
So after I remove those expenses, whatever is left is my cash value.
That's correct.
Okay. So go ahead. Sorry.
Well, I was just going to suggest if anybody's curious about their own numbers, they're welcome to reach out to me. It's very easy for us to send them an illustration, which would have a list of the cash value every single year. And it is different based on age and gender. And then you can look at that cash value and get a sense of how much you would be able to borrow against it for emergencies and opportunities.
That's awesome. And I'll ask my listeners to take advantage of it.
I'm happy to help.
So now I want to ask some questions about, when someone is working with a real estate, life insurance broker or agent, what are some of the things they should look out for? Like in example, you just mentioned about illustration, but if I'm reaching out to someone, do you have a checklist of things or I should keep in mind before signing up for a whole life policy?
Absolutely. I think one of the most important aspects of the life insurance agent's ability to help you is to have them also have some proper investments that they can refer you to for the time in the future where you've already funded your emergency fund, which, that might take a year or two. And now you're ready to borrow against the cash value for opportunities. Because if you don't have good investments to borrow against for opportunities, then you're leaving that ability to the client, which may not have the ability to find those alternative investments. So I think that's a really important aspect. And you can just ask your agent, like, first of all, do you work with whole life? Because you want to be really clear that the agent is whole life oriented, not universal life oriented.
Okay.
And then second, you want to, sorry.
No, sorry. What's the difference between whole life and universal life?
So that's a great question. And it opens up a big can of worms. So I'm going to try to answer it really succinctly. And it's easiest to use an analogy. Whole life insurance is like the most awesome car, you can Tesla, BMW, Mercedes,
Ferraris.
whatever your car is. Universal life is like the cheapest car, So, Kia, Yugo, I'm not
Hyundai.
saying anything negative about those cars. They're just less expensive and for a reason. And clearly both cars will get us to work, right? Both of those types of life insurance policies are life insurance policies. And if you die, they will pay, but the long-term nature of them is massively different. And we know that with a Kia or a Yugo, you're probably not going to be driving that car 20 years from now, 30 years from now. It's just not going to live that long.
Right.
With a Beamer or Mercedes, it might be out of date. You might have had to replace some things, but it's probably still going to be driving. And again, no political, nothing. I'm not trying to get into any of that with the cars, but it's the longevity and the assurity that car / life insurance policy, which the whole life is like the more expensive cars. It costs more, and there's a reason.
Why?
Take away the branding. There's still a reason that those cars cost more, and it's because they're going to live a lot longer. And whole life is like that. It's going to live a lot longer. It's called whole life because it is designed to be there for your whole life, meaning until you die at age 90, 100, 110, 120. I mean, all the people listening to your podcast, they're into their health. They're going to live to 130 or 140. That whole life policy needs to stay in place for a century sometimes, right? You got a 20-year-old or a 30-year-old today, they're going to live another 100 years.
Right.
The universal life policy is never going to stick around that long.
I see. Thank you for that explanation.
Yes.
So let's say I have signed up, not I have signed up, but I have reached out to this agent and I've been working on it and we finalized the policy and I'm about to sign on the documents. What are some of the things I should look for in the documents before I, do the final signature?
Yes. So you want something called a maximum paid up addition. And it's actually really easy to get. And some agents talk about like they do all this machinations and make it all special. All they got to do is check the dang box on the computer that says maximum paid up addition. Yeah, it's not that hard, but it is an important one. And then you also want to look for a couple other things. One is called a waiver of premium. That's a rider that would be available to you, assuming that you could get approved for it. Not everybody can, but if you can get approved for waiver premium, it means that if you became disabled, that the insurance company would pay the premium for you for as long as you were disabled up to age 65.
Oh, okay.
It's a pretty important rider.
Yes.
And then there's another rider that I like for the older set. So if you're like 60 and above, it's a long-term care rider. And
yes, LTC.
Yeah, same idea. You want to have that rider and able to enable you to use the policy to pay for long-term care expenses. I wouldn't purchase it if I was 30 or 40 or even 50, but
oh, really? Okay.
If I were older. And I also think it's really important that people know that you can have more than one life insurance policy. I own over 20 of them.
Yeah, me too. I was just going to say I own a term, I own a IUL, which is LTC, and of course, a whole life.
Beautiful. Good. Yeah. So those are probably the most important things. I would add one more, and it's it pretty much goes without saying, but just so people are clear, and that's that you buy your whole life from a mutual company that is participating. And what that means is it means they pay dividends. As an example, USAA is a great company. I love what they do for the military. They have fabulous car and home insurance.
They're awesome.
Well, they have whole life insurance, but it's non-participating. And so it doesn't have a commission, but it isn't, it's not an effective policy to buy. I would never recommend it.
It's not going to give me any kind of cash flow.
Right. Mutual company and a participating policy.
Okay, awesome. So Pan Mutual, Mass Mutual, some of those, right?
Yep. Yeah, there's about 20 companies that I could rattle off, and any of them would be just fine.
Okay, awesome. That's awesome. So let's say once I have acquired a policy, how to read a policy or enforce illustration. Of course, we are not going to go in detail, but if you can highlight some of the
Absolutely. So thankfully, most insurance companies these days are finally getting on the bandwagon of having online statements.
Yes.
And so you're going to learn how to read that for your own policy and the company that you are working with. And then you used a term that I'm guessing most people are not familiar with, and that's called an in-force illustration. Yeah, the word is enforce, INFORCE. And you want to get an in-force, maybe every 2 or 3 years from the company. And what it's going to show you is your current cash value, which of course is on your statement, and a projection of the future cash value growth and the future death benefit growth. And that's something people do not understand about whole life, is that the death benefit is increasing.
It's also growing.
Yep. So your in-force illustration is going to have a column showing those two things and their growth based on that current year's dividend scale. And it's a very valuable document to have. While at the same time, I'm going to encourage people to not make a whole lot of decisions about it or around that document, because you have a projection, again, based on the current year's dividend scale, which is absolutely going to change.
Can change, yep.
Yeah, but it's still a valuable thing that you want to learn how to read. And I actually have a whole video course on how to read statements and how to look at your in-force illustrations. And I can send you a link to that. You're welcome to throw it in the show notes if that's valuable to anybody there.
And that's an amazing course. Thank you for, thank you for the course. I took a look at it and it's pretty nifty. it gave me a lot of ideas about life insurance, and that's how I learned about in-force illustration as well.
Awesome.
I think the link is Whole Life 101, wholelifecourse.com, but I'll put it in the show note as well.
Yeah, it's wholelifecourse.com.
Yep. So no, that's awesome. So now my other question is, because whenever we are signing up for something like whole life, it's all about cash value, savings account, but then in the end, it's they mention about policy loans, right? So how do these policy loans work, and when one should and one should not take it out as a loan?
Absolutely. Fabulous questions. So the policy loan works very similar to real estate or like a CD secured loan, in that you have cash value. Let's say you have $100,000 of cash value and maybe your death benefit's $1 million or whatever. Okay. You have $100,000 of cash value and you're going to borrow against. I really coach clients to use the term borrow against. You're not borrowing from. From implies that you pulled it out.
Out, yeah, withdraw.
You're borrowing against, just like you would in real estate, right? It's a lien, an LIEN, against your cash value. So let's say you have $100,000 of cash value and you borrow $60,000, 60 to go do a real estate deal. And so you're going to be literally using the insurance company's money to do your real estate deal. That $60,000 is their money that they are lending to you.
Oh, I see. Okay.
And they're going to charge you an interest rate for the use of their money. And it's usually going to be between 5 and 8%, depending on whether it's variable or fixed. In the meantime, your $100,000 of cash value is going to
still
sit there.
And earning dividend.
In the policy, earning dividends. That's right. And right now, dividends from all the various insurance companies, they're netting down after all the costs to probably 3 or 4%.
Okay.
So that really begs your second question, which is, when is it a good idea to borrow against? Well, using our example, let's say you're going to borrow $60,000 against your $100,000 cash value. Let's say that your insurance company is charging you a fixed rate of 6%. And you might think that's high, low. It doesn't really matter right now. What's important is that you use that 6% money to go invest in something that earns 8-9%, much greater than your 6% cost. So that's your opportunity. Now, of course, you can also borrow against it to handle emergencies. Let's say you need a new air conditioner and it's 10 grand. Well, if you don't have a credit card that has that capability on it, you absolutely can borrow against your cash value life insurance, pay for the air conditioner, and then you would want to pay that back fairly quickly over the next maybe 3 or 4, 6 months from your own earned income.
Right.
Whereas if you can get a $60,000 loan to do a real estate deal, and again, let's say you have a cost of 6 and a gain of 9, that's like a 150% improvement.
Right. Yep.
And then you want to use that 9% income, investment income from your real estate deal to pay back your 6% loan.
I see.
So that you can do it again.
I see.
And again, and again.
So you recommend paying back that loan, right?
Absolutely. Okay. And I think that's a mistake that a lot of agents kind of talk about, and clients don't really understand what's going on. The death benefit will pay back the loan if you don't. But think about what we were just talking about earlier. You've got a healthy person. You're 40 years old when you take out this $60,000 loan. 6% interest for every single year for another 50, 60, 70 years that you're going to live. The policy cannot handle that. So you can use the death benefit to pay back your loan when you're in, if you're taking a loan when you're in your 90s all day long. But if you're in your 40s, 50s, 60s, you need to be paying that loan back so that you can use it again. That's the whole point.
I see. Okay. Yeah. So I'm not doing that. So that's why I asked. I need to start paying back the loan.
Absolutely. And here's what I recommend to my clients. Use whatever investment you are investing in and its cash flow to pay back the loan accordingly. So like I said, if you have a 9% real estate deal and it's paying you every month, use that to pay back the loan. If you're doing a real estate deal and it's a fix and flip and your 60 grand is going to turn into 80 grand in 6 months or something, then you don't have to pay back the loan at all for the 6 months. And then when you get your 80 grand, then use it to pay back that loan. Now, the only reason I wouldn't do that is if I was going to take that 80 grand and go buy another real estate deal that was going to earn me more than the 6% loan cost.
All right. Okay.
But as a general rule, you want to be borrowing, paying back, borrowing, paying back, borrowing, paying back consistently.
Okay. So rinse and repeat.
Yeah.
So let's take a quick break. I'm thoroughly enjoying this discussion. We'll be back. Welcome back to Wealth Matters Podcast. I'm talking to Kim Butler and we are dissecting life insurance. So I saw a term coined by Kim, another term, and it was clue. So what is clue?
So I coined that term to just help people remember some of the basic things that their whole life insurance policy does, because it's really easy to forget. So it's CLUE. The C stands for control, and you control your cash value. Right. The owner controls the policy. And that's a really important distinction. You can be an owner, but not necessarily be the insured.
Right.
So like I own policies on my adult children. I'm the owner. It's my account. I borrow against it. I pay the premiums. I'm also the beneficiary, but they're the insured.
Right.
So that's an example there.
Right. Yeah. Same as like Keyman also, right? Because I have for my business, my partner and I both have taken out the Keyman insurance policy.
Yep. That's a perfect example.
Okay. Awesome.
The L stands for liquidity. And this is just our reminder that this cash value account is totally liquid. And I find that people just forget that. You know, they pay their premiums and they think this money is like in a black hole, never to be seen again. And it's liquid within 7 days. So that's pretty liquid.
It's pretty fast. I get it like within 3 days. It's pretty cool actually.
Absolutely. And then the U stands for use, to remind us that we can use it for whatever we want. And for most of our clients, they're using it for either emergencies or for opportunities. And that's what I help people think about it for. You can use it for whatever you want. You can use it to go on vacation if you want. Right. It's not my favorite thing, but you can do it. I really like to have people focus on the opportunity side of things. And that means always you should leave a little bit of cash value in there for your emergency fund so that you can borrow against that if you need to for emergencies.
Got it.
And then the E, so CLUE in CLUE stands for equity. And this is just to remind us that we are truly borrowing against the cash value. And the cash value acts like equity, just like equity in a home or any real estate deal, with one difference, and that's that it never goes down. And as we know, real estate can go up and down. And you're right, like stocks too. So, a lot of people will say, well, what about a margin account? Absolutely. Very similar, but life insurance can't go down. And obviously you can have a margin call because your equity went down. But the term equity just helps us remember that the dollars are doing two jobs. They're sitting there in the cash value and they're out doing whatever it is that we're doing with them.
Okay. Well, that's awesome. So the last question I have, and again, I want to touch upon it, is the taxation side of it. So would you give me an example with numbers on how the taxes work?
Yeah, absolutely. So let's use our $100,000 example. Right. Again, we have $100,000 of cash, and we have what started as $1 million policy. And now it's probably $1,200,000. That's a fairly typical growth, because as the cash value grows, that death benefit also grows. Yeah. All right. And let's say you have a $60,000 loan. If you die, your $1.2 million is going to pay back the $60,000 loan. And then the difference, which would be $1.1 million, $140,000 would go tax-free to your beneficiaries.
Oh, okay.
And if you didn't die, your $60,000 loan is tax-free to you, because all loans are tax-free to people. And then if you always just continue to keep the policy in force, you will never pay taxes on any of the loaned money.
Oh, okay.
You will never pay income taxes on the death benefit.
Right.
And the only time you would pay taxes if you canceled the policy. So in my example, if you have 100,000 of cash value, maybe you put in $80,000 or something, you'd be taxed on that $20,000 difference. But the whole goal is to not pay taxes. So you want to keep the policy in force.
Right. Oh, that's awesome. That's a great explanation. Thank you.
You're welcome.
Anything else we forgot to discuss?
Well, I think it's always good to bring up, where can this go wrong? Like,
Right.
you know, what's the downside of this? And there's a couple answers that I want to give to that. So I think one of the first downsides is that when you tell your friends that you're interested in whole life, or you're buying whole life or whatever, you need to be prepared for 9 out of 10 of them to say, yuck, why?
Yeah.
What are you doing that for? It's just a very misunderstood
Happened
product.
with me so many times.
I believe it. I believe it. The second downside is it's absolutely a long-term deal. Like if you're just wanting to do this for 5 or 10 years, don't bother. It's not going to work. I mean, it would work, but not very well. And it's not what you should do.
Okay.
And then where it can go wrong is what you were hinting at earlier. And that's, you know, if you don't pay back your loans for 2, 3, 4 years, no big deal. But you cannot keep that loan on the books forever and ever and ever. Now, I'll admit, I've had some loans on the books close to 20 years. I've been working with the product for almost 30, because I keep finding good investments that are making use of that money. So I don't mind continuing the loan.
Okay.
But if I'm just either losing the money or blowing the money, that is not a good thing. And I cannot keep that loan on the books in that way.
Got it. And that's exactly what I'm doing as well. I'm investing, so making sure it's making money.
Yep.
That was great. How can my listeners reach out to you?
So the easiest place to start is our website, which is partners4prosperity.com. So partners4prosperity.com. And if they want to go to /subscribe, there is a special book there. So you can maybe put this link in the show notes, partnersforprosperity.com /subscribe.
Yes.
There's a book there called Financial Planning Has Failed. And it talks about the whole life insurance, obviously, as an alternative for cash. And it also explains a lot of the alternative investments that we like to use to get people these 7, 8, 9% interest rates, whereby they can actually borrow against their cash value, or maybe they just use regular money like IRA money or other dollars and go straight to the investment, where you can earn a decent interest rate and ideally not lose principal. We're not perfect. You know, we lose principal too, but we try really, really hard not to.
But that's the number one rule of any investment. Don't lose your principal.
You got it.
So, no, that's awesome. Thank you so much.
You're welcome.
I thoroughly enjoyed the discussion, and thank you for taking time out of your busy schedule, and have a great rest of the day.
Sounds good. You too.